Have you ever looked at your paycheck and wondered, where did half of it go? Or maybe you finished filing your taxes and felt like you just signed away money you didn't even have. Here's the hard truth. Most people overpay their taxes simply because they don't know the basics. Every year, millions lose out on hundreds or even thousands of dollars, not because of scams or bad luck, but because no one taught them how taxes really work. And no, you don't need to become a CPA or memorize the tax code. You just need to understand a few key ideas. And that's exactly what this video will give you. So stick around, because by the end, you'll know how to save money, make smarter financial choices, and finally understand the system that affects every dollar you earn. Let's start with the foundation. What types of income actually get taxed? You earn money in many ways. Salary, freelance gigs, side hustles, investments. But did you know not all income is taxed the same way? Here are the common types of income you'll run into. Earned income. This is your salary, hourly wage, or freelance income. It's taxed as ordinary income, meaning it's subject to the highest tax rates. Investment income includes things like dividends, interest, and capital gains. This is often taxed at a lower rate. Passive income. Rental properties, royalties, affiliate income, all taxed, but often with different rules. Business income. If you run a side hustle or a full business, your profits are taxed after you subtract your expenses. Each of these has its own tax treatment, and that's why some people earning the same amount pay wildly different taxes. That brings us to the next big concept, understanding tax brackets. Let's clear up a common myth right now. If I move into a higher tax bracket, I'll lose more of my money. Wrong. Tax brackets are marginal. That means only the income within that bracket is taxed at the higher rate, not your entire paycheck. Imagine tax brackets like stairs. You pay a certain tax rate on the first portion of your income, then a slightly higher rate on the next portion, and so on. For example, the first $10,000 might be taxed at 10%. The next $20,000 at 12%, the next $30,000 at 22%, and so on. So, if you earn more, you still keep more. You're not penalized, just taxed more on the extra. Understanding how brackets work helps you make smarter decisions about income timing, bonuses, and deductions. But what exactly counts as income? That leads us to a very common point of confusion. What is taxable versus non-taxable income? Not everything that looks like income is taxed. Here's a breakdown of taxable versus non-taxable. Taxable income includes wages, salaries, bonuses, business and freelance income, investment earnings, interest, dividends, cryptocurrency gains, rental income. Non-taxable income includes gifts up to a certain limit, life insurance payouts, child support payments, some types of employer reimbursements, certain scholarships or grants. Now, here's where it gets tricky. Sometimes income starts out non-taxable but becomes taxable later, like 401k withdrawals. So always ask, is this money taxed now, later, or never? Knowing this helps you choose the right investment accounts, avoid surprises, and legally minimize your taxes. And speaking of reducing taxes, let's talk about what are deductions and how they work. Let's say you earned $60,000 this year. That doesn't mean you'll pay tax on the full $60K. You can reduce that amount using deductions, which lower your taxable income. There are two main types: standard deduction, a flat amount that everyone can subtract as long as you don't itemize. It's simple, automatic, and most people use it. Itemized deductions. If your deductible expenses, like mortgage interest, medical bills, donations, add up to more than the standard deduction, you can itemize them instead. For example, donated to charity? That might be deductible. Paid student loan interest? Deductible. Have a home mortgage? Part of the interest might be deductible. And deductions are powerful. If you deduct $5,000 from your income, you're not just saving $5,000. You're reducing the amount taxed, which means more real cash stays in your pocket. But here's something people often confuse with deductions. So, now that you understand deductions, let's clear up the confusion between deductions and credits, because they're not the same. Think of it like this. Deductions reduce your taxable income. If you made $60,000 and claimed $10,000 in deductions, you're only taxed on $50,000. Credits reduce your actual tax bill, dollar for dollar. If you owe $5,000 in taxes and have a $1,000 credit, you only pay $4,000. That's why credits are usually more powerful than deductions. Some common credits include the Earned Income Tax Credit, EITC, for lower income earners, the Child Tax Credit, the American Opportunity Credit for education expenses. Some credits are refundable, meaning if they reduce your tax bill below zero, you get the extra back as a refund. Others are non-refundable. They can only reduce your tax bill to zero, but not beyond that. So, when planning, don't just look at what you can deduct, look for credits too. Because a credit can literally be worth more. Now let's talk paperwork, because understanding the forms can help you file accurately and catch mistakes. Here are the key ones. Form W-2. If you're an employee, this is what your employer gives you. It shows your total income and how much was already withheld for taxes. Form 1099. If you're a freelancer, contractor, or have side hustle income, you'll get this instead. There are many versions. 1099 NEC for non-employee income, 1099 DIV for dividends, 1099 INT for interest, 1099B for stock sales. Form 1040. This is the main form you file to report your income, claim deductions and credits, and calculate what you owe or what refund you'll get. Other helpful forms. Schedule C for business income, Schedule D for capital gains and losses, Schedule A if you itemize deductions. Even if you're using tax software, it helps to understand these, especially if you're self-employed or have multiple income sources. Let's be honest, taxes can feel overwhelming, and that's exactly where people slip up. Here are a few common mistakes you'll want to avoid. Forgetting to report all income. Even small freelance gigs. The IRS receives copies of your 1099s too. Missing deductions or credits, especially if you qualify for education credits, retirement contributions, or medical deductions. Filing too late. If you miss the deadline without filing an extension, you may face penalties, even if you don't owe anything. Claiming dependents incorrectly. Only one person can claim a dependent per year, and doing it wrong can delay your refund. Not saving tax documents. Keep your records for at least 3 years. If you're ever audited, you'll need them. Being careful with your filing isn't just about following rules. It's about keeping more of what you earned. Want to lower your tax bill without doing anything shady? Here are some legit strategies to consider. Contribute to retirement accounts, like traditional IRAs or 401ks. Contributions often reduce your taxable income now, and your money grows tax-deferred. Start a side business. You can deduct expenses like a portion of your home office, internet bill, business meals, and equipment. Use health savings accounts, HSAs. If eligible, these allow you to contribute pre-tax dollars, invest them tax-free, and withdraw them for qualified expenses. All tax-free. Invest for long-term capital gains. Holding investments for over a year often means lower tax rates when you sell. Donate to charity. Contributions to qualifying charities can be deductible if you itemize. The wealthy don't just earn more. They understand how to structure their finances smartly. And that's something anyone can start doing, regardless of income level. Now, you might be thinking, can't I just hire someone to deal with all this? Sure, you can. But here's the catch. No one cares about your money more than you. Even if you work with a professional, understanding how taxes work empowers you to ask better questions, spot missed deductions, avoid overpaying, plan better for your financial future. Knowledge gives you control, and control gives you options. How to earn, how to invest, how to keep more of what you make. At the end of the day, taxes affect everything, from your paycheck to your retirement plan. So whether you're just starting out, growing your wealth, or optimizing your business, having a basic understanding of taxes is one of the most powerful financial tools you can have. If this video helped simplify taxes for you, make sure to like, subscribe, and turn on that notification bell, because we've got a lot more practical financial breakdowns coming your way. Drop a comment if there's a topic you want us to cover next, and remember, financial literacy is the first step to financial freedom.